This is the Global Wealth Show with Grant Connis and Andrew Costa.
At a young age, people very close to me were really hurt by the financial markets, and that drove me to be in this industry.
The vision was to change the industry.
Everybody calls this your nest egg, and I think of it as so much more than that. This is your life savings.
So being that guide, that coach for our clients is why we do what we do.
What we do could change someone's life.
The Global Wealth Show begins now.
Welcome to the Global Wealth Show. I'm Ben Bauman. Today, Grant and Andrew are here to discuss whether the market is overdue for a correction. And in today's global perspective, we'll be discussing why controlling market volatility in your investments is critical to your retirement strategy. Plus, they'll answer your questions from AskGlobalWealth.com. Grant, Andrew, welcome.
Thanks, Ben.
Thank you, Ben.
Here.
Yeah, it's great to have you here once again. Let's talk about that first nugget there. Is the market overdue for a correction?
Yeah, I think it's a great question, Ben. It's definitely on a lot of people's mind.
Yeah.
And we've had a great run here, obviously, in the market since 2009, pretty much straight up. But I think a lot of people start to get complacent. You know, they tend to forget how devastating 2008 was to them and their lives and their portfolios. And as we move on here through this market, I think now is more important time than ever to really assess your risk and what you can stomach as an investor, so that that never happens to you again. Because if you're approaching retirement, if you're within 5 to 10 years out from retirement, or maybe even if you're living in retirement, right, and we have another major market sell-off of 30 or 40%, that could devastate a lot of people as it relates to their income and making sure that their money lasts them as long as they do.
And so there's, how do we figure out what my risk tolerance is? I'm guessing it's different for everybody. Certainly it's different for someone at 35 as opposed to someone at 55, right?
It definitely is, Ben. I mean, and what so many of you are coming in to do now is exactly what Grant was just talking about, is just let me make sure that I'm not exposed to too much risk, because I have had this really good run. And what does all that mean if you don't protect it? You know, you've made a lot of money over these last 8-9 years, and if the market tanks and goes the other way, what did it do for you?
Right.
It did nothing. So the good thing is so many of you are coming to the office and you're thinking forward and you're saying, well, what do I do to make sure I do protect this? And the first thing we do is we do this risk analysis that tells us what's the most that you could make in a good market and what's the worst that you could lose in a bad market, given what you own right now. So it tells us, what it does is it tells us whether you have a problem, whether you are taking on more risk than you're willing to take. See, it's okay to take some risk on the downside. Maybe you can handle or stomach, we always say, maybe 5 or 10% or whatever your number is, in order to have those big gains when the market's doing well.
Okay.
Some of you say, I don't want any risk. I forget it. No risk at all. I can't lose a dime. And there's solutions around that. Maybe your gains are going to be a little smaller, but there's solutions around that as well. But once you have that risk analysis done, what it means for you is it means that going forward, you don't worry anymore about what the market is going to do, because you know you've now set up your portfolio in a way where it will never lose more than you can stomach.
Wow.
And so that's really, really powerful.
Right. Okay. And so it's all the more important to be working with a financial advisor who can take a look at my portfolio and analyze how much risk I'm setting myself up for, and am I comfortable with that?
Yeah, I think it's, as it relates to working with a financial advisor, I think it's probably less important as you're earning and saving for retirement, because time's on your side. You're adding money every month or every paycheck in your 401k or your retirement plan, and if we do have a sell-off, you have time to recover.
Right.
But if you're within 5 to 10 years out from retirement, or you're living in retirement, it's essential to be working with an advisor that can focus on putting that plan in place. And it all starts with understanding and defining the amount of risk in your portfolio, what you're comfortable with as an investor. Because just because everyone lost 40% in 2008, that doesn't make it acceptable.
Right.
If you're someone that can't stomach losing more than 5 or 10%, or maybe it's even 0%, like Andrew said, believe it or not, you can construct your portfolio and your plan to do just that. You can put it together to do exactly the way you want it to be as an investor.
Yeah. So everybody's different. Everybody's an individual. They need their own individual plan, so to speak. Do you have people who come in and show you what they have as far as a nest egg, and say, yeah, I'm conservative. I'm not at too much risk. And then you run the analysis and it shows something maybe quite a bit different than what they thought?
All the time,
Oh, really?
Ben. I mean, it's probably the most common thing that we see is that you are taking on more risks than you actually realize or want or think you want. And so that's why it's so important is once you know that, now we can craft solutions around fixing it if that is a problem for you.
Yeah, thanks, guys. It's so important to be working with a financial advisor and knowing the risk level you're taking. Do you know? It's probably time you find out. You know, we're talking about a correction. Is it coming? When might it come? Also, controlling market volatility and how critical that is to your retirement. We'll get into that when we come back, though. First, here's how you can contact Grant or Andrew at Global Wealth Management. We'll be right back.
Are your investment accounts exposed to too much risk? How will your nest egg be impacted the next time the market experiences a major correction? Now is a great time to get a retirement roadmap review with Grant, Andrew, and the team at Global Wealth Management.
It's one of the most important things that you can do for yourself and for your family.
Here's what they'll do. Review your current strategy and expose some of the hidden weaknesses of your retirement portfolio. Compile a fee report to uncover how much you're really being charged in fees. Show you safer money alternatives. Plus, we will stress test your portfolio and do a risk assessment of your current retirement accounts.
It's about planning for your future. It's about planning for your dreams.
Call Global Wealth Management now to get started on your retirement roadmap review. And if you're one of the first 10 qualified callers, you'll receive the top 10 things to consider when preparing for retirement guide. Call now. You're watching The Global Wealth Show with Grant Connis and Andrew Costa.
We're discussing your retirement with Grant Connis and Andrew Costa from Global Wealth Management. Guys, we've been talking market correction and when the market does correct, if it's similar to what we've seen a couple of times in the past 17 years or so, that can be devastating to someone's retirement.
It really can be, Ben. And as you know, this was a big reason that I chose to be in this industry. I've seen this firsthand. When I was 19 years old, my life was turned upside down in a car ride home with my dad. I was getting picked up from college, and I went to go open up the car door, and immediately I could see that there was something really wrong. And I went ahead and got in the car and asked him, what's going on with you? What's wrong? And being the guy that he was, he didn't really want to talk about it, of course. And we had quite a long drive home, so kept asking over and over again, because this was more than just a bad day. I could tell that there was something very wrong. And so finally, my dad turned to me and he said, and for the first time in my life, he just completely broke down. And he said, Andrew, what's wrong is that your mother and I have lost a big portion of our life savings due to this tech bubble crash of 2000 and 2001. And like so many people did. I mean, so many people got hurt. And I remember just kind of sitting there in the car and thinking to myself, how does something like that even happen to someone at this point in my life? I don't really think I understood how you do that. Sure. And I just remember back on how hard that was on all of us. And of course, like many, over 4 or 5 or 6 or 7 years, you do kind of come back from that. And luckily at that point in their lives, they had time to come back from that. But so many of us get into situations like that where you don't have the time. You're in retirement already. You don't have the time for these types of market corrections and this volatility. And so the good thing is I got into this industry because of that story that I just told you. And we are set up as a firm as capital preservation and income specialists where we specifically seek to correct that kind of life event from your portfolio. So you never have those situations where you wake up one day and you've just been devastated from the market correction and the volatility.
Yeah, and depending on when that correction happens, what stage of life that person is in, it can have a tremendous impact if someone's already in retirement, for example, and too much risk in their portfolio, a 2001, a 2008, can make a tremendous difference.
It really can. You know, we call it the two most important phases of one's financial life. You have the accumulation phase, which is growing your investments,
Sure.
you know, building your nest egg over time. That might begin when you're in your 20s and 30s and you start saving for retirement. And then you have what we call the capital preservation and income phase, like Andrew just mentioned. And that's, you know, once you've reached retirement or you're within 5 to 10 years out, and that's where you really want to make sure that your money lasts you for the rest of your life. The important thing to understand is that the strategies and the planning and the investing that you do in the accumulation phase of your life is oftentimes far different than that of the capital preservation and income phase. And you know, we sit down with dozens of prospective clients every single week as they come into our offices and take advantage of our retirement roadmap review, which is our second opinion services. And there's so many people today that are in their late 50s, 60s, 70s, or even their 80s, but they might as well be invested like they're 20 or 30 years old. They don't make the shift from that accumulation phase into the capital preservation and income phase. And what happens is they are taking a lot more risk than they think they are. They're not controlling that volatility a lot of times in the accumulation phase. And then when we're able to kind of get them more towards that capital preservation and income phase and really realize where they are and get their retirement back on track, it gives them a lot more peace of mind. And this is what it really comes down to. Think about if you have $1 million portfolio and and all of a sudden the market's down 20% and you're now down $200,000,
Right.
and you're making decisions in your retirement about your lifestyle around that money. Maybe it's the trip you always wanted to go on. Maybe it was a cruise to Alaska or to the Bahamas or whatever that might be. Or you get the call from your son and it's your grandson's first Little League game and you have to fly across the country to that, but you can't do that because you're down $200,000. That's what kind of impact this can have on your life and your lifestyle. So getting it right and making sure that your retirement's on track so that never happens, it gives you a lot more confidence as an investor.
Yeah, absolutely. And you guys mentioned something that controlling this market volatility is actually more important, especially during retirement, than the rate that you're earning on your investments. Is that true?
It is true, Ben. You can actually, sometimes the tortoise does really win the race.
Yeah.
I mean, you can set up a portfolio that is that doesn't have the ups and downs and is a little bit more steady. And even if you end up with a return that's a couple % less than someone else with a more volatile up and down portfolio, you can end up with more money. Sometimes it's twice as much money.
Wow.
So we'll look forward to looking at that here in a minute.
Absolutely. I know you've got a great illustration, and if you don't know how much market volatility can impact your nest egg, you really want to see this. Andrew is going to go through this strategy for surviving market volatility. It's must-see information. Please stay with us.
Are your investment accounts exposed to too much risk? How will your nest egg be impacted the next time the market experiences a major correction? Now is a great time to get a retirement roadmap review with Grant, Andrew, and the team at Global Wealth Management.
It's one of the most important things that you can do for yourself and for your family.
Here's what they'll do. Review your current strategy and expose some of the hidden weaknesses of your retirement portfolio. Compile a fee report to uncover how much you're really being charged in fees. Show you safer money alternatives. Plus, we will stress test your portfolio and do a risk assessment of your current retirement accounts.
It's about planning for your future. It's about planning for your dreams.
Call Global Wealth Management now to get started on your retirement roadmap review. And if you're one of the first 10 qualified callers, you'll receive the top 10 things to consider when preparing for retirement guide. Call now. You're watching The Global Wealth Show with Grant Connis and Andrew Costa.
Welcome back. In today's Global Perspective, Andrew shows us how controlling market volatility may be more important than your rate of return. Andrew?
Thanks, Ben. What I want to talk to you about today is how controlling market volatility is actually more important than the return on your investments. See, our whole lives, we are programmed to think about one thing when we're looking at our investments, and that's return. We look at all the things we do based on how they have performed in the past and the return that we feel like they will perform at in the future. But what I want to show you is that actually ends up being the second most important thing. The first most important thing is controlling market volatility. So let's take a look at the chart on the screen of the S&P 500. Now, why do I show the S&P 500? Because it's an example of a very volatile portfolio. So as you can see, this is the S&P 500 from the year 2000 down to 2016. What we have is $1 million going into the S&P 500, and you have the down years there in the early 2000s, the down years in '08, but as long as you closed your eyes to all that and you just let it go, you would have averaged about 6% average rate of return. And your $1 million would be worth $2.1 million today. Now, a lot of people will look at that and they'll say, well, what if we had all the good years first and then the bad years of the S&P 500 after that? So on this right-hand side, this is exactly that. If we had some magic wand and we could turn the market upside down, this is the S&P 500 upside down. What you see here is it's the same return of 6%, and our $1 million comes out to be the same, $2 million. So it doesn't matter whether you have the bad years in the beginning or the good years in the beginning. It's the same 6% rate of return, and your $1 million does the same thing. It goes to $2 million in both scenarios. Now let's take a look at taking out income from the portfolio. Everything changes when you start to take out income. So over here is the regular S&P 500 averaging 6%, an example of a very volatile portfolio. You put in your $1 million, you take out $50,000 a year, so you've taken out $850,000, and at the end you have $366,000 left, which is kind of interesting because you're only taking out 5% and you're earning 6%, but you're going backwards, which I'll explain in a second. Over here, the upside down version of the S&P 500. All the good years first and then the bad years at the end. Same 6% return. On the prior slide, both examples were exactly the same, ending in 2 million. Over here now, we've taken out $50,000 a year from this upside down version of the S&P 500. We've taken out $850,000, and wow, we have $1.2 million almost at the end. How is that possible? We have 6% here, 6% there, $1.2 million over here, and $366,000 on the real S&P 500. Here's why. You start out taking 5% from the S&P 500, and the first three years are very volatile. So you end up 3 years down the road at $500,000. Now you're taking out 10% per year from your portfolio. There's no book or class that tells you when you retire you should start taking out 10% from your portfolio. So the market roars back, and because you're taking out 10%, you don't really get to roar back. And then 2008 happens, and you go down 37%. Now you go from 616 down to 338, and you're taking out 15% per year. You're not spending any more money, you're taking out the same $50,000, but it equates to 15% of your portfolio. The market then roars back on this amazing time that we've had over the last 8 or 9 years, and you don't even get to benefit from it because you're taking out 15% per year. Over here on the upside down version of the S&P 500, you're averaging the same 6%, but as I said, you're ending with $1.2 million. Why is that? Because this is a less volatile version of the S&P 500. It's all the good years first. For the first 13 years, we have almost no down years, and so we end up with a much larger amount of money at the end, even though we average the same return. So you can see here that a less volatility can cause you to have way more money down the road. Now let's take a look at a real life example. What we show up here is one of our conservative portfolios that we manage. We have a team of expert portfolio managers around the country that craft these portfolios for us and for our clients, specifically around controlling volatility. And this is an example of our conservative portfolio, which averages 4.8%, but has almost no volatility, almost no times where the market is down or where the portfolio is down. So we put in our $1 million, we take out $50,000 a year, we take out $850,000, and only averaging 4.8% from a less volatile portfolio, we still have $877,000 left of our $1 million. Over here with the S&P 500, as we saw before, our $1 million is worth only $366,000, averaging 6%. So literally, almost 2 times as much money, averaging about 1.5% less of a return, because you end up controlling market volatility and making sure that that is the most important thing. So as a firm at Global Wealth Management, that is what we focus on, controlling market volatility. And with that, back to you, Ben.
Thanks, Andrew. That's a really dramatic illustration of the power of controlling market volatility. We're not done yet. Coming up, Andrew and Grant will be here to answer your questions. Stay with us.
Are your investment accounts exposed to too much risk? How will your nest egg be impacted the next time the market experiences a major correction? Now is a great time to get a retirement roadmap review with Grant, Andrew, and the team at Global Wealth Management.
It's one of the most important things that you can do for yourself and for your family.
Here's what they'll do. Review your current strategy and expose some of the hidden weaknesses of your retirement portfolio. Compile a fee report to uncover how much you're really being charged in fees. Show you safer money alternatives. Plus, we will stress test your portfolio and do a risk assessment of your current retirement accounts.
It's about planning for your future. It's about planning for your dreams.
Call Global Wealth Management now to get started on your retirement roadmap review. And if you're one of the first 10 qualified callers, you'll receive the top 10 things to consider when preparing for retirement guide. Call now. You're watching The Global Wealth Show with Grant Connis and Andrew Costa.
Welcome back to the Global Wealth Show with Global Wealth Management. We're here with Grant Connis and Andrew Costa, and in the time we have left, they're going to answer some of your specific questions. Ready, guys?
Yeah, let's do it.
All right. How about this one from Ted in Coral Springs? My wife and I are hoping to retire in 2 years. We've saved a little over $1 million, but I'm concerned whether that's enough. I'm concerned about running out of money.
Well, it's a great question, Ted, and I'd say it's probably the number one question that we get asked when individuals come into our office and take advantage of our retirement roadmap review. It's, have I saved enough for retirement, and how do I make sure my money lasts for the rest of my life? And going through this process and really making sure that you have a sound plan in place to get you from point A to point B, whether that's through the last 5 or 10 years of your working career into retirement, or even if you're in retirement, getting you through the rest of your life, is absolutely essential that you have that type of plan put in place.
Yeah, so planning is important. It's not just as simple as, trying to accumulate as much as I can and then start withdrawing from that. You have to plan that out and know how you're going to go about that, I guess, right?
You do, and that's what we do through our retirement roadmap review. It allows you to go through these steps throughout your life. It allows you to say, okay, well, what's going to happen when I take my Social Security? Right. How much do I need to take from my portfolio to meet my needs? What about taxes? What do I do with taxes? Is there a way to be more tax efficient? All these different things. How do I create enough income so that I don't have that chance of running out of money? And so when you have that plan in place, what it does is it really brings clarity to the whole situation. It allows you to know that, I can see here by following this plan, I'm going to be okay. It's like saying I'm going on a vacation. You plan for vacation. You say, okay, here's my flights, here's the hotels I'm going to do, these are the activities I'm going to have. Right. And when you do it that way, of course, you end up having a really great time. With retirement, it's the same thing. You plan out these different phases of your life so that you don't have that question of, is there a chance that I run out of money?
Yeah.
And here's the problem. A lot of people are really flying by the seat of their pants in retirement. They have statements, they have investments, but they don't have a formalized plan in place to get them from point A to point B. Yeah. And it's like anything in life, the only way to be successful is to have a plan. Have a business plan, have a game plan. It's the same thing with retirement. You got to have a formalized written plan to get you from point A to point B, and you really got to have someone that's there kind of guiding you and making sure that plan's executed properly.
Yeah, right. That's key.
Yeah, all right. Great answer. Here's another one. This is from Susan in Aventura. My broker is recommending a variable annuity. Is this a good investment for me?
Well, we would really need to know, Susan, that's a good question, but we would really need to know your entire situation. So what I would ask is, if you're thinking about that or if your broker's offering that to you, ask why. How does it fit into this plan that we were just talking about? What's the purpose of it? Why is this the best thing for me? How does it fit into my plan? And in general, we're not huge fans of variable annuities, and there's a couple reasons why. Usually with a variable annuity, or with annuities in general, if you're interested in them, you're probably interested in them because you think that they can protect your downside. They can protect, and some of them do that. Some of them definitely do that, and for those, I think that they can be pretty decent. With a variable annuity, it will not do that. The reason they call it a variable annuity is it's invested in mutual funds and it goes up and down with the market. So if you're trying to protect your downside, a variable annuity will not do that. The other thing with variable annuities is they're very expensive. Usually they'll cost 3, 4, 5% per year in annual fees. I mean, that is just too much for me. I mean, that could add up over the next 20 years. If you're paying 5% per year in fees, that's 100% of everything you have in the variable annuity getting eaten up in fees. So I would just be very careful. We've developed an annuity analyzer that allows you to really understand what you're being offered or what you might own if you own an annuity, and it can be very helpful.
Oh, yeah, that sounds great.
Yeah, and I think annuities in general, I think the problem is they're a very misunderstood investment. You don't really know where to turn to get the answers. It really all depends on who you ask. And they're not a bad investment. There's some annuities that are actually okay for people. They're just not right for everybody. They're not right for everything. And to really understand really what you own, if you own an annuity or you're thinking about buying an annuity as an investment, you know, we encourage everybody to go through that annuity analyzer. It's like a stress test of your annuity. You know exactly what you're paying to own that annuity. You know exactly what the income is. You know what the risk is, whether it's a variable annuity or a fixed annuity. So it really allows you to assess the situation as it relates to the annuity and give you a lot more confidence as an investor to make sure you own the right annuity.
It tells you the truth about how it works, not how you've been sold it.
That's a good point. All right, guys, great information. Thanks so much. That's all the time we have this week. But remember, if you have a question, you can go to AskGlobalWealth.com or call the number on your screen. For Grant, Andrew, and the team at Global Wealth Management, I'm Ben Bauman, saying so long.
Are your investment accounts exposed to too much risk? How will your nest egg be impacted the next time the market experiences a major correction?
Whether you're in retirement or nearing retirement, now is the time to secure your financial future.
Is your nest egg ready to help you meet your retirement goals for the rest of your life?
At Global Wealth Management, we want you to succeed.
Global Wealth Management is a South Florida investment management firm that specializes in capital preservation, income investment, and estate planning strategies for those planning for or living in retirement. Now is a great time to get a retirement roadmap review with Grant, Andrew, and the team at Global Wealth Management.
It's one of the most important things that you can do for yourself and for your family.
Here's what they'll do. Review your current strategy and expose some of the hidden weaknesses of your retirement portfolio. Compile a fee report to uncover how much you're really being charged in fees. Show you safer money alternatives. Plus, we will stress test your portfolio and do a risk assessment of your current retirement accounts.
We believe that planning for retirement should be taken very seriously.
Call Global Wealth Management now to get started on your retirement roadmap review. And if you're one of the first 10 qualified callers, you'll receive the top 10 things to consider when preparing for retirement guide. Now is a great time to get a retirement roadmap review with Grant, Andrew, and the team at Global Wealth Management. Call Global Wealth Management now